Hi friends, if you are doing value investing now, there is an extremely high probability, 90% in fact, that your returns are not as good as the overall market, the index, or worse, losing money, like Warren Buffett. If you are in the 90%, I'm going to explain to you why value investing is outdated and give you an alternative. If you want to know how I got the 90% figure, I'll link a research below from the Standard & Poor's. It doesn't get more reliable than that. I'm also going to cover the sectors you should be looking at going forward. So this video is a continuation of the previous video I did. I'll link it up here and down below too. Seeing how many of you have commented having a mindset shift, I'm very happy and I will add more value in this video. It is very important now to do such videos because more than ever the stock market has gotten crazier. So I hope by doing such videos more often, I hope it improves your investment journey. We'll appreciate the early thumbs up, it helps a lot out in the channel. Why do I think value investing is outdated? The key principles of value investing is buying cheap companies. Yes, I know there is a lot more to it and I get it from your comments. In fact, everybody has their own definition of value investing. But I will never accept that value investing is in the same category as investing in innovation. It is just not the same. To me, that is just trying to twist and turn the definition of value investing. So, I have many stories to tell you on investing failures and I will give you some examples. These examples are very vivid in my mind because I've seen so many people around me years ago lost money. One of them is like back in 2015, some idiot financial guru said lumber Liquidators is on sale. It's a great company, financials look awesome, plenty of market share, simple business, nation's largest specialty retailer of hardwood flooring. It is so cheap, let's buy. This was the stock chart of liquid Liquidators. Coming out of the 08 crisis, the stock went up so much all the way until $120 and the stock fell $120 all the way to $50. Massive discounts from the high of $120 and it meets almost every single matrix of value investing. If you look at the revenue, it's constantly going up for 4-5 years. You look at the earnings per share, it is going up. It's an awesome company. Looking at even more depth into the financial ratios, the key ratios, return on equity, meaning to say that the amount of money put in, they get back how much? 15% returns, 20% returns, 28% returns. These are all above average stats for value investing. Returns on asset, that means the assets they have, how much returns they are getting back. Look at that, it's all above 10%, maybe 1 year less than 10, and it's constantly going up. This is a simple business, it just makes flooring, and suddenly some things happen to it, the stock price dropped from $120 to $50. Yeah, right, if you buy cheap, guess what? Years down the road, it got even cheaper to almost no value. If you zoom out, it looks like a big middle finger in your face. I got tons of examples. Let's continue. Foot Locker. I'm sure most of you have heard of this company. How do I know these companies? You see, when shit happens, investors will flood to me for my opinion. While I appreciate investors coming to me, they shouldn't be in this mess in the first place. This company is an American sportswear and footwear retailer and they're operating in 28 countries. Wow! Let's look at the value investing matrix, the financial matrix. Let's talk about like the standard stuff like earnings per share, revenue, dividend, ROE, ROA, that kind of stuff. Let's go, then after that we'll go to the charts. If you look at Foot Locker, consistently you look at their revenue keep going up, which is good. The business revenue, it's going up, means more and more money they earn every year, even until this year, 2020. Earnings per share, wow, perfect. Look at the dividends, wow, perfect. The payout ratio is quite conservative at about 30%. And if you do the standard matrix, you look at every single numbers here, they meet the checklist. If you look down below, return on equity is pretty good, return on assets, and you look at all the numbers here, they are all in the green. There are seldom minuses here and there. So this is a typical workflow of a very good, financially strong company. If you look at this chart here, Foot Locker has been around for a long time, since beyond 1998 all the way. And you look at the stock price has been going up since the financial crisis. Wow, high quality company with amazing numbers. And one day from like $70 nearing 80, it drops to $30. Cheap! Wow, it is really cheap. Yeah, right. If you As I said to you, if you buy cheap, it goes cheaper. It's like catching a falling knife. This is value investing. You get my point by now, right? So now stocks are crazier. If buying cheap is a stupid idea, what do you do? Okay, this is not my first time saying this, but I will keep repeating it because you need to know. The question you need to ask is, what is the only matrix that will ensure the company's growth? No economic mode, copyright and patents are going to protect a company. Look at what happened to Kodak. Look at what happened to the taxi industry, etc. The only matrix that ensures the company's growth is innovation, constant innovation. You keep ahead of the competition with constant innovation. Competitors will never be able to keep up. So I have two key criteria for innovative companies which I use. So the first one will be proof of concept must work, and the second is they must prove they're able to scale up the business effectively. So if you look back in history like Amazon, they proved that the bookstores are irrelevant, and once that was achieved, they used every single profit to scale their business. So scaling took many years, but they proved they could. Scaling is the hardest thing in the entire process. You have seen so many promising companies in your life, the amazing concepts, but 99% of the time they disappear into the dark. Think about the amount of amazing breakthrough technologies you heard of, disappeared. WeWork failed because they couldn't scale properly. Think about the amount of car companies that succeeded in America. I think the last car company succeeded was in 1915, and after like almost 100 years, Tesla was successful. So many failures along the way. Do you remember Lily Drone, the drone that's supposed to follow you without controlling? They received $34 million in funding but failed to scale. The Game of Thrones ending was also a failure. Sorry, no link, but I had to add it in. With the recent IPO of Nikola, I am not buying into that company until they prove they can scale. On top of that, they believe in hydrogen technology. That is so stupid. I'll talk a little bit on hydrogen technology. This technology is also worked on in Toyota. They basically take a lot of power resources to get hydrogen. So extracting hydrogen from the air is not easy. So it's very power intensive. So you take all that power to extract hydrogen, and you take this hydrogen to put it into a car. So this hydrogen can power the fuel cells inside. So you think about the energy conversion from the power grid to hydrogen, hydrogen transferred to the car, and the car got to convert it to electricity. It's a super inefficient way. And on top of that, you're putting a hydrogen tank in your car. Hello, have you heard of a hydrogen bomb? So this technology is so stupid and so inefficient, and Nikola is part of it. I am not buying into Nikola because they are selling you a dream, and to do real world practical stuff, I believe they do not have the right management to do it. Investing in innovation is one of the hardest work I've done in investing, but it is also the most rewarding. Innovation gets adopted faster when a crisis happens because it makes so much sense. Faster, cheaper, smarter, more productive, efficient, etc. So moving forward, I recommend you to focus on your attention on these two sectors, basically technology and life science. I foresee tons of money rotating into this sector. As the whole stock market collapsed, you saw what happened to my portfolio. If you missed that video, I'll link it up here and down below. So when a crisis hits, people will start to think what they really need, and it becomes like a need versus the wants. You saw Zoom gaining traction. Technologies that was a good to have became a must have. Innovation gets adopted quicker. Like DNA sequencing became a must. You see this flu-19 virus took a few days to sequence compared to 3 months back in SARS. So I bought the stock that has a 70% market share of the sequencing machine. That's just an example of life science. So when you look at payments, this technology, don't you think paying by cash is really dumb? You know, last year when I was in Hong Kong, I paid using cash and I felt really dumb. People instantly knew I was like from some backward country. They knew that I wasn't from China. The whole China is cashless. It's cleaner, more efficient and safer. Why the heck you want to use cash and all that coins? So annoying. So now with Flu-19, this technology will be adopted faster. Tesla, my biggest position in my portfolio, is pretty obvious because it's cheaper, cleaner, safer, less maintenance. This Flu-19 is going to stay with us for quite a while, and I foresee a shift from using public transport to private transport. So concluding this video, don't just buy stocks because it's cheap. cheap will become cheaper. Instead, buy into innovation. So the two criteria that I apply to choose innovative companies, number one is the proof of concept must work. Number two, they must prove that they can scale. Scaling is the hardest. Take it from someone who ran 3 to 5 companies at one point. It is crazy hard. Lastly, look at these two sectors, technology and life science. This is where I see the money rotating to. Appreciate those to help me with the thumbs up. You are awesome. Invest safe.